All right, picture this. Your US company just handed you RSUs worth 35 lakh rupees, and they finally vested last year. Amazing, right? But hold on a second, because India just went ahead and added that entire 35 lakh rupees directly to your taxable income. And you're probably sitting there thinking, wait a minute, I haven't even sold a single share. I literally don't have this cash in my bank account. Well, that right there is exactly how this massive tax trap gets sprung. It catches thousands of tech and corporate professionals totally off guard every single year. So let's get into this explainer. You get that awesome vesting email notification popping up on your phone. It feels great. But what that notification doesn't tell you is that this 35 lakh rupee is getting hit immediately with the Perquisite tax, even if you haven't sold a single share. To the Indian tax authorities, the exact second those restricted stock units vest and become yours, it's treated exactly as if your boss just dropped a massive pile of cash on your desk as a salary bonus. The tax liability is immediate and it is heavy.
So here is the brutal 10-second math on how this works. Your taxable perquisite amount is literally just the fair market value minus your exercise price. And since RSUs are a completely free grant from your company, your exercise price is zero. That means the entire fair market value of that 35 lakh rupees is added to your income and taxed at your highest slab rate, up to 30% plus your surcharge and cess right out of the gate. You're basically paying a huge tax bill on wealth that is completely locked up in shares.
Let's look at the timeline here to see exactly how this builds up. At the grant stage, it's really just a promise from your employer, so there's no tax. The taxman completely ignores it. But the vesting date, that's when you officially own the shares. That is your access event, and bam, the Perquisite tax hits. And then, because you actually own those shares now, any future growth in their value triggers a totally separate second tax event when you finally decide to sell them. And this creates what we call the double tax trap. You're paying income tax on the base value the minute you receive the shares, and then capital gains tax sits right on top of that for the profit when you sell. Now, the good news is the fair market value you were already taxed on during vesting becomes your new baseline, your cost of acquisition. So you aren't taxed twice on the exact same rupees, but make no mistake, you are absolutely staring down two very distinct, heavy tax levies on a single asset. When you finally do sell, the capital gains math kicks into gear. You're looking at 12.5% for long-term gains, or up to 20%, and sometimes even your full slab rate for short-term. But pay super close attention here if you hold US RSUs like Google, Amazon, or Microsoft. Under Indian tax law, foreign stocks are actually considered unlisted. That means you have to hold them for a full 24 months after vesting just to qualify for that 12.5% long-term rate. Sell before that 2-year mark, you're paying your highest slab rate all over again on those short-term gains. Now, if you have US RSUs, things get even messier. The US broker is probably withholding taxes right at vesting, which creates this crazy cross-border nightmare where both countries want a slice of your equity. You might check your brokerage app and see a sell-to-cover transaction, meaning shares were automatically sold off just to pay the US government. But guess what? The Indian Income Tax Department still views that full 35 lakh rupees as your taxable income. It's a highly dangerous scenario where you could easily end up paying taxes on the exact same equity to two completely different governments. To escape paying twice, you absolutely must get relief under the DTAA by obtaining your tax residency certificate and filing Form 67 before your ITR to claim the foreign tax credit for those withheld U.S. taxes. If you happen to work at an eligible Section 80 AIC startup, you get a lifeline through the ESOP tax deferral, allowing you to legally push that massive Perquisite tax bill down the road for up to 48 months. Looking ahead, the new Income Tax Act 2025 extends this deferral to a full 60 months, starting in 2026, but it also enforces much stricter merchant banker valuations to determine that fair market value. Navigating this entire Perquisite trap, the cross-border forms, and the upcoming 2026 laws is a complete minefield, where a single mistake could literally cost you lakhs of rupees in unnecessary taxes and penalties. So, honestly, did your CA actually mention any of this to you? If not, DM me the word ESOP right now for a free equity tax calculation so you don't get caught off guard.